As we start the new year, indexes are pushing all-time highs. The S&P and Nasdaq rose over 16% in 2025 on the back of AI tailwinds. And if you're not careful, it's so easy to get sucked right back into the hype. I'm going to tell you right now, many of the best opportunities for 2026 are not in the names you keep seeing come across your newsfeed. They are hiding in plain sight, companies with strong fundamentals, solid balance sheets, and real long-term upside, but for different reasons than you've heard. They have been left behind. Today, I'm going to talk about 3 stocks that I'm personally looking at right now before January ends and why they might be some of the best values for disciplined investors heading into the new year. 2 of these stocks I actually currently own, and the other I used to own, but has now fallen over 50% since I had my shares called away from me with covered calls. I got very lucky in that regard. Now look, anyone can just tell you what they're buying, but that's not what we do here. At Everything Money, we want to teach you how we are fishing. I'm not showing you these companies because I hope they go up. I'm showing them to you because they fit my process, and based on where they are today in terms of price versus value, they look attractive. I don't follow hype. I look at the story, but we look at the numbers, and then we figure out what we're willing to pay both based on those 2 things combined, not just based on one or the other. That's what real investing is all about. So in this video, I'm going to walk you through each one of these stocks that I'm looking to buy early in 2026. I'm going to show you the good, the bad, what I perceive the potential risk and potential rewards are for these companies. Then we're going to run them through our stock analyzer tool, which is used over 1 million times per year by our users, and it'll help us find the price that makes the most sense. Because at the end of the day, investing isn't just about what you buy. It's about the price you pay for what you're buying. Now remember, just because I own a stock does not mean anybody on the internet should go and buy it. I'm here to teach a process. I don't care who it is. Even if you told me, Paul, I bought this company because Warren Buffett did, I'd say, why? Your goals are different than Warren Buffett's. Your analysis is different than his. If it falls, he knows what he can handle. If it falls for you and you just copied him, what are you going to do? It's so important. So, stock number 1, our first stock, Target. Now, Target's had a rough couple of years, from inventory problems to consumer pressure, political noise, and the inventory problems were a lot of theft. It has been a headline machine. But if you actually look under the hood, you're going to see a company with real cash flow and a customer base that still shops in-store week after week after week. I still see reels on Instagram, on TikTok, on Facebook of women trying to hide their Target purchases from their husbands. Now, Target operates over 2,000 stores across all 50 states, serving millions of customers through both physical locations and digital channels. This isn't some speculative stock, guys. This is a real giant with over $100 billion in revenue, and they're trying to execute a strong recovery. Now, here's what turns many investors off. Their shares are down 25% year to date and over 50% from its highs back in 2021. Boo-hoo. That's only price movement. What we have to understand is it justified or is it too far? Here's what you need to remember. While falling prices scare many speculators out there, true investors understand that they create opportunity. Prices falling change opportunity because when the price falls, the investment idea changes. So we need to take a deeper look. Now, guys, like I said, Target's at $95 a share, which doesn't mean much to me, but for a lot of people, 4 years ago, they were at $236 a share. That's a big fall, guys. That's 60%, 65%, something crazy like that. It's a $43 billion market cap business, which means you bought all the shares. That's how much it would cost you. Revenue of $105 billion. Now, there's a big enterprise value, which means there's a lot of debt in the company. But that's just retail leases for the most part. So it doesn't worry me as much. For those of you who are obsessed with dividends, big dividend payer. Almost 5% now, mostly because the stock has fallen. But it eats up 2 of their $3 billion of free cash flow. But guys, they're selling for less than 15 times free cash flow, less than 12 times earnings. Profit margin, 10-year profit margin, 4.18, 5-year, 4.14, 1-year, 3.6. So it's a little down right now, but hopefully that's a temporary thing. Now, look at this. 3-year revenue growth is negative. 5 years positive, 10 years positive. And of course, negligible acquisitions. But something I love here, their 5-year return on capital is 14%. Now, this is a very technical term, but it's really important that everybody understands it. This is basically how good is the company. Can they take money, invest it in the business, and get a good return on it? If they can't do that, they're not generating wealth for their investors. If they can do it, they're generating wealth, they can compound their growth and really increase their profit very quickly. Now, I want to remind you, this may sound complicated. If this is your first time and you feel overwhelmed, guys, you're not alone. I was overwhelmed. Buffett's been overwhelmed. Everyone is overwhelmed. We're here to simplify this as much as possible. And I assure you, I guarantee you, that if you spend more time watching videos, you will be in the top 1% of 1% in terms of understanding investing in companies. You are going to wow the people around you by your understanding. And I'm so confident in this, that I've made all these key metrics and their importance in an easy cheat sheet, a PDF that you can get absolutely free. Click the link below, boom, and you'll be able to download this PDF, keep it next to you when you're looking at any company. It's a great way to level up your investing game. This is exactly why I teach on YouTube. I was sick of hearing people talk about, well, the stock is up and that's why I think it's going to do. No, it's about understanding what a business is. And when you buy a stock, you are buying a piece of a business. Now, here are the 8 pillars. Now, net income is down. Free cash flow is down. Now, the free cash flow might be from the COVID years when cash flow was insane because people were having to buy things, but they couldn't go, it was very limited to a few stores that would allow people to go pick up. Higher debt, but again, I understood why. So I'm not really that worried here. They're buying back shares, good returns on capital, revenue's up, and the reasonable metrics here. So it tells a story. And the story is telling me it's probably not as bad as we think. Are they in a permanent decline or is it a temporary decline? That's the question we have to ask ourselves. This is a really important thing to understand by looking at these 8 pillars. Now, in a couple of minutes, I'm going to go through the right price to pay for this stock based on our assumptions about the future. But first, let's look at these analyst estimates. Now, analysts had a 15% drop coming to $7.50 a share in earnings, but then growing back again. Not big growth, $7.50 to $10 over the next 4 years. Again, not big growth. But remember, you don't need big growth to make a lot of money. You just need to pay a good price. That's what's key. And revenue, basically flat and then growing at a couple percentage points a year. Not anything special. But again, if it's not sexy to us, it's not going to be sexy to all the other lemmings out there who are just watching it fall off a cliff because they think the stock going down means it's a bad company. I want you to really remember that here. Now, this takes us to Stock Analyzer tool. Guys, what is this tool? This is where we merge the numbers and the story together. We take our story, we input our numbers based on that story. What's the revenue growth, profit margin, PE ratio for 10 years from now, and what return do we want? It spits out, not including the balance sheet, the right price to pay based on a discounted cash flow model. So for me, I did a 10-year analysis. Now, 10-year return on capital is 13.2, 5 years 13.9. I like that. It's getting a little bit better. But guys, look at this revenue growth assumption I did. 2, 3, and 4%. Nothing big. Nothing at all. First off, they're going to add stores, and inflation alone will drive up revenue. So I actually think this is kind of conservative. Profit margin, 3, 4, and 5. Same with free cash flow. Now, what is the PE and price of free cash flow 10 years from now? Not along the way, not today, at the end of 10 years. Guys, I always tell people, you start with 15 or 16, which is the market average. You go higher for good companies, lower for bad companies. I consider Target a good company. Why? Good returns on capital. People love it. Women love it. They're doing a great job. They just created this thing called Shipt. It's like $49 a year and you get unlimited same-day delivery. That's how you compete with Amazon. Yes, Amazon does some same day. But I look at this saying, all right, not bad. The other thing I like about Target, and I will say this over Amazon, if I have to return something and I have an issue, it's much easier to go to Target and say, this is my issue, handle this. With Amazon, what am I doing? I'm putting it in a box, hoping and praying for the best. And by the way, Amazon does great, but it's a great way for Target to really up that game to say, how can we compete with this? And I think that's really important. So I put 17, 20, and 23 in terms of my earnings and free cash flow multiple for 10 years from now. Now, what is my desired return? So guys, I put in 9% here just to get the intrinsic value. What's the company worth on the market? And then from there, though, I had to put some margin of safety. What's that margin of safety? It's a higher return. I just don't know how high is too high or too low. It all depends on your personal feel. So I hit the analyze button. The stock's currently at 95. This is why I'm interested. Low price of 106, high price of 250, middle price of 170. This current price return means if I paid today's price and my assumptions occur, what's my return? My middle assumption return is 17.5%. That includes the dividend. Don't add the dividend back into that. This is a discounted cash flow return. It doesn't care what the company does with the cash flow, just what the cash flow generates. Stock number 2, Nike, another company that I own. This company has been beaten up worse in terms of price. Now, Nike is the world's largest athletic apparel and footwear company, known for iconic brands like Jordan, like LeBron, Converse. It sells products in more than 190 countries through a mix of direct-to-consumer and wholesale partners. The company's new CEO, Elliott Hill, has stated that Nike is in the middle of innings of a comeback focused on long-term growth and strong profitability. Now, time for me to let you in on a secret. A few short years ago, Nike was a darling of the stock market, trading at over $180 per share. The company had increasing revenue, rising profits. At the time, I made a video. And I said, you know what? I think Nike's overpriced. I think I'd be interested below 100. People were saying in the comments, and you can go find this in the comments, Paul, you're such an idiot. Nike will never be below $100 per share. Guys, you don't know what's going to happen. These things are crazy. Fast forward to today, that 180 is down below $60. That's almost 70% drop from all-time highs. They're trading at prices, lower prices than they were 10 years ago. But for real investors, as prices fall, things get more interesting. The question I have for you is, do you think this world exists 20 years from now without Nike? And if you think Nike's still around, do you think revenue be higher or lower than it is today? Will profit be higher or lower than it is today? That is my main question. So the metrics to look at. Dividend lovers, 2.75% eats up a big chunk of their free cash flow. And by the way, their free cash flow is down. Their 5-year average is a shade under $5 billion, and they did $3 billion last year. They're turning things around. They're selling for 28 times current free cash flow, 17 times 5-year average. Returns on capital, 18% a year for the last 5 years. Of course, it's lower lately because they're turning things around. Gross profit, 42%. Every item they sell has 42% of it in profit. 42% of it. Their margin in the last 10 years was almost 10%, 5 years, 10.5%. And that includes last year's garbage 6.23. So their margins are climbing slow and steady. This is a very good thing, guys. Guys, look at this. 5-year return on Nike without dividends is down, just the price is down 60% in the last 5 years. And their all-time high was 179.10 5 years ago. 4 years ago, sorry, 4 years ago. So let's go to the 8 pillars. 8 Pilla Thrilla. 8 green check marks. Guys, I'm a big fan of stocks going down because if the company is smart, let's say the stock fell in half tomorrow. By the way, if we have a bad bear market, that's not unreasonable. Let's say the stock fell in half tomorrow. Cancel this dividend and just buy back every share imaginable. It'd be a $40 billion market cap business. You need to buy back cheap shares. Okay, let's see what the analysts are saying here. A decline of 22% in terms of profit, and they think growth comes back almost $5 per share in 2030. And then revenue, okay, flat, 2% up, 5%, 5%, 7, 5.5. Okay, so that's for the next 5 or 6 years. Now, we have to do what we do best, which is go right into our stock analyzer and pull up Nike. Let's see what assumptions I made for the next 10 years. I did 3, 5, and 7% revenue growth. Reasonable, nothing insane, nothing small. The other thing is I didn't increase their profit margins by a ton. I did 9, 10.5, and 12. Now, this is a premium business, high returns on capital. It's Nike. They dominate. They're around. I don't see how they get taken over anytime soon. It could still happen, but this is a company that's going to be around for a very long time. I applied a PE and price of free cash flow of 19, 22, and 25, and of course, my 9% desired return. Now, I hit the analyze button. The stock's currently at $57. I have a low price of 50, high price of 110, middle price of 75. So guys, based on today's current price and the middle assumptions, I'm at a 12.5% return discounted cash flow on Nike. 12.5% for a company like Nike. That seems pretty awesome to me. For me, it works. Maybe not for you, But I really encourage you to go take a look at that because I think it's important. Now, last up, Sprouts Farmers Market, ticker symbol SFM. Now, guys, this one doesn't get the headlines like Costco or Walmart, but Sprouts is a high-margin specialty grocer that's quietly executing incredibly well. This is the company that I bought in the low 30s, 31 to 33. It ran up to 165. It got taken away from me, went even higher, and then I got lucky. It collapsed. Sprouts focuses on natural, organic foods, and they have carved out a niche with health-conscious shoppers who are willing to pay up for quality. The company is expanding its footprint across the U.S., especially in fast-growing states like Texas and Florida. And unlike a lot of grocers that compete on price, Sprouts competes on product and experience, which leads to higher margins and a more loyal customer base. Here's why this has my attention. I was buying the stock back, like I said, in the early 30s and had my shares taken away. But Sprouts Farmers Market is on my list of companies I want to own forever. So now that it's pulled back over 50%, remember, look at this price here. Let's pull it up right here before we go any further. It is currently at $80.50. I was buying it in the low 30s. The question is this still a good price? Because one mistake a lot of people make is they buy something cheap. And as it goes up in price, it might be worth it. And they're sitting there going like, I don't want it. I bought it low 30s. That is something I am battling with right now. Is it still worth it? That's the question we have to ask ourselves. So let's go look at the metrics. $8 billion market cap. All-time high of 182 back in June. Oh man, I was so mad when I lost my shares and went to 180. I was like, no, but that's the way it works with covered calls. But I love this. $8 billion market cap, $10 billion enterprise value. Only $2 billion in debt. Granted, they're small. They have 400 stores, but their goal is to get to 12 to 1,500. Guys, this is what I love. Look at their profit margin. 10-year profit margin, 4.1%. 5-year, 4.7%. Last year, 6% almost. And here's the key. They are expanding in their Sprouts private label. This is if you look at their gross margin here, it's 39%. Their Sprouts Farmers label is 50 to 60% gross margin. This used to be much lower than this, 38%. As they sell more and more of their Sprouts brand, this could drive up. Guys, you know how hard it is for a grocery store to make 6% profit margin? I think this could be a 7 or 8% profit margin business. That's what's key there. I just hope they're able to execute before somebody comes in and buys them because of how amazing they are. Oh, they're incredible. Good returns on capital, especially for a company that's growing. It's hard to get that kind of 11, 12% returns on capital. 8 pillars. All right. High on the 5-year PE and 5-year price of free cash flow. But guys, it's a growing business. They have a lot of potential. I'm ignoring that completely. And their debt level, kind of high. Why? Leases. Okay. Let's go to analyst estimates here. Look at this. 530, 585, $6.60, $7.30, then $8. $8 per share in 4 years. Revenue growth, look at this. 15%, 10%, 9%, 9.5%, 9.5%. This is predicated on sales going up because that's what inflation does. Prices go up, and also opening more locations. They have an aggressive plan of opening a lot of locations. I have made every possible investing mistake you can imagine. I bought too high. I sold too early. I listened to the wrong people. And that's exactly why I built Everything Money. It was first built purely for me. I wanted the tools that gave me clarity and decreased the fear of investing. People saw me using these tools on YouTube and said, Paul, can you share those? And at first I said, no, it's a data feed. But then I realized I could make this. So I did. And the real community was born. Real people sharing ideas, live chats, live streams, and tools that help you beat 99% of investors, but most importantly, help you sleep better at night because money can be very scary. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator. So stop guessing, start learning, start sleeping better. Try it for $7 for 7 days. I'll see you in there. So let's go to our Stock Analyzer tool. What is Sprouts Farmers Market worth? SFM. 10-year analysis. I did 6, 8, and 10% revenue growth. Profit margin. I did 5.5, 6.5, 7.5. I'm giving that benefit of that growth and profit margin. PE, 16, 19, and 22, and my 9% desired return. I hit the analyze button. The stock's currently at 80. Low price of 96, high price of 220, middle price of 150. See what I mean, guys? Don't get yourself attached to the price you already paid. This is looking like a good price here. So guys, there you have it. Target, Nike, and Sprouts. 3 companies, 3 very different stories, but all of them share something very important. Real business with real fundamentals that might be mispriced. Now, guys, there's no way to say these are guaranteed winners. Nothing in this world is. But if you're willing to look past the noise and ignore the hype, you'll put yourself ahead of well over 99% of other people out there that are investing. That's what we're focused on helping you learn here at Everything Money. It's not about chasing the next big thing. It's about building long-term wealth using logic and discipline. Now, if you thought this breakdown was interesting, wait until you see what I did next. I handpicked 7 stocks that I believe can actually beat the Magnificent 7 over the next 10 years. And I'm going to be honest with you. Even I was surprised by the results. You're going to want to see who made the list. So click on the video on your screen right now. Thank you for your time.